Take a look at the energy complex this morning. You can see $71, perfect for people in the oil patch. It's not too hot, not too cold, just enough to keep production going, but not too expensive for consumers either. Joining us now, Daan Struyven, Goldman Sachs, co-head of Global Commodities Research. We're going to talk energy, but we're also, we were just off camera talking about gold, and I think it might be your favorite. Why? I can't help myself with Brian Gumbel once in a while. I have to do it, but it's your favorite commodity. Why?
Yeah, two reasons. The most important reason is that we think that central bank demand for gold will structurally remain higher.
I ask again, why?
Why? Because I think that EM central bank reserve managers in mid-22 got a wake-up call when they saw that Russia's central bank's reserves got frozen and are wondering, are treasuries necessarily always risk-free? And is there not a strong case to diversify and increase the gold holdings, which cannot be taken away? And we think that this trend is here to stay. The second reason is gold is a great hedge against tariff escalation, concerns about debt sustainability. And so both in your base case, you have a lot of upside with gold going to $3,100 per troy ounce by year end. And then you do quite well to protect your portfolio in those risk cases.
So the central banks, explain again, the sovereign debt became less, or at least there was a little bit more risk involved with sovereign debt. So to diversify, they said, we're going to buy gold. That's purely why they're doing it.
That's right. In mid-22, Russia's central bank reserves invested in the dollar, euro, and other currencies, Western currencies, were frozen. So they became, without any value for those EM central bank reserve managers. That was a wake-up call. And we have actually seen an increase, a five-fold increase in EM central bank gold purchases since mid-22, which is really a watershed moment for EM central bank reserve managers.
And I asked you also off camera, what about why gold rather than Bitcoin? And you said Goldman Sachs does not, you don't cover Bitcoin at all.
Our
commodities research.
Our research team currently doesn't cover Bitcoin. I think there is one fascinating similarity between gold and Bitcoin, which is that supply is very limited. It's very difficult to get gold out of the ground.
Actually, a lot of similarities, but that's one of them.
That's the most important one. There are also some key differences. If you just look at the historical risk-return profile and what those two assets could do to portfolios, gold has recently booked solid returns, but Bitcoin returns have been very strong. But on the flip side, volatility has been incredibly high. And so if you're looking for a safe haven asset to hedge your portfolio against stale scenarios, we think that the lower risk properties of gold are quite attractive.
You're the co-head of Global Commodities Research. When you have meetings with the other co-head, I don't know who that is.
Sam Dart, my great colleague.
Oh, your great colleague. And all your minions that work for you, do you talk about ever covering crypto?
It's definitely an ongoing conversation topic within our team.
When's it going to happen?
To be discussed. Yeah.
All right.
Including with management. Let's
get back. We said we talk about energy, and I said 71 is almost perfect. Is it not?
Yeah. So while in the short term you could argue that high uncertainty about U.S. policy could increase oil price volatility, over the medium run we actually argue that the new U.S. administration is very much supportive of our Brent range call, 70 to 85 for Brent, 65 to 80 in WTI terms, both because as long as Brent is sort of below 85, which is U.S. retail gasoline prices below $3.50 per gallon, it's not a major issue politically. That's sort of the energy affordability part of the sweet spot. And then as long as Brent is above 70-ish, TI above mid-60s, you are above the break-even cost of most U.S. producers. You can continue to expand production, and that's the U.S. energy dominance part of the sweet spot of oil prices we forecast.
Yeah, it's almost just right. So we had one of I guess he's just sort of he's not a colleague at your own firm, but you know who Jeff Curry is, and
yes.
I'm sure you followed him along.
Mentor, former manager, absolutely.
Yes. So if we wanted to increase production here, he says we couldn't. Further, 3 million, no way to get another 3 million barrels a day out of the U.S. Is that true?
So we have seen solid ongoing growth in U.S. energy production, but we're seeing a shift away from crude, indeed. But we're seeing pretty rapid growth in terms of natural gas liquids. And then on the gas side, we are going to need a lot more extra US natural gas production to meet all that extra LNG demand, as we're going to continue to add LNG export terminals. So overall, US energy production will continue to grow at a solid pace, but indeed, we expect an ongoing slowing in US lower 48 crude growth.
But drill, baby, drill will not bring about $40 oil. That's what I was worried about. If we really, the spigots are open already, are they not?
Yes, we think that the most important driver ultimately of US oil production is prices. At the margin, if you remove some of the regulatory barriers, that could support medium-run production growth somewhat, but the key driver of US oil production is very much prices and capital discipline from shareholders.
Russian oil is off the markets or on the markets? It's been on the entire time, has it not? Will there be any change from a peaceful resolution?
We would not expect a change in Russian crude volumes if sanctions were to ease in the context of a peace deal. Why? Because the main reason that Russian crude production is constrained is a self-imposed constraint, which, in the context of OPEC plus coordination between Riyadh and Moscow, very different from natural gas markets, where volumes are down 88% from Russia to Europe.
And Iran, what can we expect? I mean, we have no idea what's going to. And there are some people, you saw the article last week that Israel may or may not do something this year with I don't know what that would do to oil, but what if something with the nuclear facilities happened with Israel?
Yeah, so base case, Iranian crude oil production declined somewhat, around 350, 400 KBD in the context of a return to maximum pressure under the new US administration. But I think the risks are skewed towards significantly lower Iranian crude production, and that could cause a lot of short-term upside to oil prices. For instance, if both Iran and Russia crude production were to fall by 1 million barrels per day in the context of tighter sanctions enforcement, TI could go to the high 80s in our framework, at least in the short term, until the UAE and Saudi Arabia likely respond by raising more production.